Hello, everyone. I'm Rob Mextrot. Thank you for joining today. I'm here to cover two topics. One is a 2021 market recap, and then I'll focus on a 2022 market projection with some commentary on what has taken place this year so far. Just for context, I'm recording this on Friday morning, February 4th. Let's get into it. The first page I have here is the 2021 market recap. It says a very good year. It was a good year for markets, and it was a good year for City National Rockdale's economic and market research. We'll cover what we got right here first. And when you look at what we got right, first, optimism on the economy strength, corporate profits, and direction of interest rates. If you go back to the start of 2021, it was not clear that the economy was set to have a big year. There was a lot of political uncertainty. There was COVID uncertainty. I was certainly getting a lot of questions with concerns of investing headed into 2021. And we had a 20+% year for US stocks. Our optimism on risk asset outperformance really came true. When you look at bond performance, which we will, it was a horrible year for traditional bonds and a great year for stocks. It was also a great year for US stocks relative to international markets. US stocks strongly outperformed international emerging markets and developed markets. And then on the bond side, opportunistic income. Opportunistic income was the winning solution. Opportunistic income outperformed traditional bonds, outperformed cash, and our overweight position in opportunistic income really helped. If you look at the bottom of this page, you'll see the different asset classes and the City National Rockdale overweight or underweight stance. So when you look at US large cap equities, we were overweight. Those equities returned over 20% on the year. Mid small cap stocks, not as high of the performance that large cap stocks got, but still a very nice year for those. We were overweight small and medium cap stocks. Now look at developed international market equities. Those underperformed US markets significantly. We had an underweight position to those, a fairly significant one. We don't own any developed international investments. When it comes to emerging markets, Asia was the one category we got wrong last year. We were overweight Asia. Asia had a negative year coming off of a big year in 2020. Most client portfolios did not have a significant position in that asset class. So when you add everything up on the equity side, very good year for our strategies and research. And then on the bond side, it was a huge year because the one category that returned negative last year, investment grade bonds, is our underweight position. We have been dramatically overweight the three different opportunistic categories, and look at the return difference there on the bond side. Big outperformance on the traditional bonds. It doesn't stand out as much as the stocks because the stocks were looking at 20% returns in US stocks, but going from a negative 1.5% number to a positive 4 or 5%, makes a huge difference in a diversified, balanced portfolio. So to me, that may have been our single best decision from 2021, overweighting those opportunistic bonds. Now, what we got wrong, inflation. We weren't alone getting this wrong. Inflation shot up toward the end of 2021. We did not get transitory inflation, which we were projecting earlier in the year. But the good news is that we had portfolios positioned to be inflation resistant. Stocks are the best inflation hedge in our opinion. So you can see the returns in the stock market came at a time when inflation was higher than expected. So we have updated our inflation view. I will get to that in a minute, but that was one thing we missed last year. And then emerging market equities underperforming. I just touched on that. We were underweight international as a whole, which was good, but we picked the wrong countries focusing on Asia. So all in all, a very good year, very good returns across diversified portfolios in 2021. Now, 2022, what is our outlook headed into the year? And we've been faced in January with a market correction. At the highs, we've seen the S&P 500 correct roughly 10% after the 20% plus year we had last year. So what is our outlook? And it's actually a positive one, despite that volatility. You can see we're maintaining our overweight to risk assets. We view this volatility as an opportunity. That remains the case, and I'll talk about why. When you look at consumer and corporate fundamentals, to me, this is the key line for why you want to be optimistic right now. Consumers are still in great financial shape spending money. Companies are sitting on record profits right now. They have more job openings than ever before, and profitability is great. You see delinquencies as far as corporate bond defaults and companies struggling very, very low. And same thing goes with consumer delinquencies. Very good situation for both consumers and companies. I will talk about inflation in a second, but we are increasing our targets for inflation. But look at the second half of the year. We expect it to moderate as we get into the second half. So let's take a look at our economic and financial indicators heading into 2022. Just like I said about being optimistic, you see 17 out of 20 of the indicators are still green. I'll start by a couple of the cautionary ones. We have the geopolitical risk indicator is back in red. We have the situation going on in Russia, tensions high in that part of the world. We have the ongoing tension with China and the rest of the world. It makes for a tricky geopolitical environment. And I always joke that it's probably 2 or 3 of these events a year that we're used to. If it's not Russia or China, it's the Middle East, it's North Korea, it's debt crisis across the world. We do have these geopolitical risks that pop up, but they tend to not drive U.S. economic conditions very much. So it's dangerous to worry too much about the geopolitical risk if it's not going to have a huge effect on the consumer and corporate profit situation I just talked about. How does X world event affect company-wise earnings, profits, revenue growth? That's an exercise we like to go through. And when you look at companies like Apple and Amazon and Home Depot and Walmart and Costco, I just talk about these companies so much because their profitability is very stable and growing. This morning, we're getting Amazon earnings reports. The stock is up 14%. We had big earnings reports from Apple and Google. And these are the bellwether companies these days in the U.S. So I'd brush off the Facebook earnings report, which wasn't good, and focus more on these consumer-oriented companies that are doing quite well. So all in all, why is the market volatile if companies are sitting on record profitability? Well, it's all about the Fed. The headlines in the financial news these days and across mainstream news as well is the Fed is going to reverse course and start raising interest rates. And the Fed is fighting against higher inflation. And inflation has been the big story. But to me, over the last 2 months, and this morning we got a jobs report that shocked the economic world in how good it was. And what this is doing, why I want to focus on the labor market next, is that the Fed was fighting inflation late last year. That hasn't changed too much. But with the job market changing, with the unemployment rate around 4% and falling, with the job market tightening and 10 million job openings with only a couple million people looking for work, the Fed is coming out and saying now, we don't need to assist the job market anymore. The job market has come back. There are issues beyond our control that might be preventing some people from seeking work right now, but low interest rates isn't going to make a difference at this point. So this is why the market is acting up. The Fed is likely to raise interest rates 4 to 5 times or even more in 2022 because of strong economic growth, low unemployment, and high inflation. And the repricing that's going on is, what is the world going to look like with 5 more rate hikes? And that affects businesses differently. When you look at the highest risk, highest growth stocks, those do very poorly as interest rates go up. So it's not a surprise that the DocuSign, Peloton, Robinhood, Coinbase, Netflix, Airbnb, ARK Innovation Funds, those companies and those strategies are in for a rough time, even after this pullback this year. So when we talk about how we want to invest in this market, the economy is good. We're going to have higher interest rates because the economy has recovered so quickly, but that doesn't necessarily mean that stock prices have to go down over the next couple of years. Quality companies can do just fine. So that leads me into the final discussion here is what are our projections for 2022? Real annual GDP growth. How much is our economy going to grow? Corporate profit growth. How much are companies going to grow their earnings by? 3.5% to 4.5% is our real GDP growth number. That's a pretty strong number. Look at 2019. In the period before the pandemic, our economy was only averaging about 2% growth a year. So we're still talking about above average economic growth, and we're still talking about significant growth in corporate earnings, even after a 45 to 50% jump that we had last year. So if these two projections hold, which we have evidence to support that they will, this should not necessarily be a negative year for stocks, even though we've been presented with a pullback. On the inflation stuff, we think inflation will cool down from the 7.1% we ended last year, more like 4% by the end of the year. But that's still high. That's still much higher than our last 20-year average of under 2%. So we want to prepare for higher inflation throughout the year. And that means inflation-resistant stocks need to be part of the portfolio. It's not necessarily gold and cryptocurrencies that are the inflation hedges. It's high-quality, profitable U.S. companies. They were the great inflation hedge last year. There's not a surprise that U.S. markets were up 20% when inflation ran hot last year. And then finally, interest rates. I'll end here with our interest rate forecast. The Fed funds rate here reflects 4 to 5 hikes. And then the 10-year Treasury, 2 to 2.5%. My biggest takeaway there is those are still historically low interest rates. So if interest rates stay in this range, to me, that's not enough to derail the economic expansion that we're in. That's not enough to make U.S. companies unprofitable. And it means that this volatility we're experiencing in 2022 is likely to be a great opportunity, even if it gets a little worse in the next couple of weeks. So thanks for tuning into this. Hope this was helpful. Looking forward to doing this again soon. Take care.